This next segment of our video is really the meat of the chapter. It's determining how to record cost of goods sold and ending inventory under 4 different inventory costing methods that are allowable under GAAP. So remember, we have the dollar amount of goods available for sale. This is made up of beginning inventory plus our purchases. And then, depending on the costing method, it'll determine the amount that we allocate to either ending inventory for the amount that's left over or cost of goods sold for the amount that's sold. You can imagine in the real world that inventory costs change every time we make a purchase of inventory. It may not be by a large amount, but it's still changing nonetheless. So if we buy something for $1, then buy the same good for $1.10, then buy the same good for $1.20, and we sell one of them, the question becomes, which one do we sell? We need to know in order to calculate cost of goods sold. Is it the $1 in one, the $1.10 one, or the $1.20 one? The answer to that question is going to be dependent upon the inventory method that the company chooses to use. There are 4 different types of inventory methods: specific identification, FIFO, LIFO, and average cost. The 4 inventory methods are going to give us different amounts for ending inventory and cost of goods sold. Specific identification is going to be used for high value, low volume goods. And basically, it's the easiest of the methods for calculation because we just tell you which one is going to be sold. So let me give you that example I had before. We have 3 items, A, B, and C. A was $1, B was $1.10, and C was $1.20. With specific identification, if I tell you we sold item B, then cost of goods sold is the $1.10 because I told you so. And then ending inventory would be what's left over, which would be the $1 and the $1.20 added together. If I instead told you that we sold item C under specific identification, cost of goods sold would be $1.20. Why? Because I told you so. And then the leftovers would be A and B added together, or $2.10. With FIFO, we start at the top and work our way down to the bottom. So with FIFO, the first purchase, A, is deemed to be sold first, followed by B and C. So if we sell one item, item A is deemed to be sold under FIFO, leaving B and C as our leftovers for ending inventory. LIFO is the opposite. LIFO starts at the bottom and works its way up. So if we sold 1 unit under LIFO, C would be sold at $1.20 and A and B would be deemed to be left over. Average cost, as you can imagine, takes an average, and we'll talk about that a little later. The choice of inventory method is not necessarily based on the physical flow, and we'll learn as we progress in this chapter that managers make their decision on inventory method based on its impact on the income statement and what they're trying to achieve rather than the physical flow of goods. However, sometimes I think that thinking of the physical flow can be useful. So for FIFO, I always think of perishable goods. So like your milk, you want to be selling that if you're Shaw's or Market Basket or any other supermarket, you want to sell it on a FIFO basis, meaning the first one you buy is the first one you sell. However, as a customer, when we go in, I don't know if you're like me, but you go into the store and you're looking at the back of the shelf, reaching out back, trying to get the newest milk. You're trying to get the last one that they purchased and buy that. But they want you to buy goods on a FIFO basis because if they sell all the new stuff and they're left with the old stuff's going to go bad. So FIFO, I like to think of the physical flow being perishable goods like milk. With LIFO, I like to think of a pile of dirt. So here's a pile of dirt or mulch. I just spread a bunch of mulch at my house. It's a big pain in the butt. But the way mulch works is when the landscaper buys mulch, they put the mulch on top of their pile, and then when they sell me the mulch, they get it from the top. They don't lift up the whole pile and take the old stuff. The last item that they put on top is the first item they end up selling. So that's what LIFO's physical flow would look like. And then average cost is just somewhere in the middle of LIFO and FIFO. It gives us an average. And we'll talk about how to calculate that. It's important to understand, though, that I can use LIFO for milk and FIFO for dirt if I want to. There's no requirement under GAAP to choose a method that mirrors the physical flow of the goods. We can choose any method we want, and that means in a problem, we'll tell you the method to use and you just do it. So let's go through an example for Harley-Davidson. On January 1, they had beginning inventory of 2 units of Model A leather jackets at $70 each. Then they purchased 4 more units at $80. Then they purchased another unit at $100 and 4 more units at $120. 3 units remain in ending inventory. So the first thing we should do in a problem like this is set up a nice chart like the one you see here. So we've got our beginning inventory, then we have our 2 purchases, which means overall we have 7 leather jackets for a total of $560, and the goal of each inventory method is to figure out which ones are sold and which ones are left over. In the problem, it told me ending inventory is 3 units, which then means cost of goods sold would be 4, because we either sell it or we don't. So I only have to tell you ending inventory or cost of goods sold. I don't have to tell you both. In this problem, it told us that there were 3 jackets left over, so that means 4 must have been sold. The question becomes which 4 are sold. So I like to branch off a little bit from the textbook in this because the way they present it to me is confusing. So when I'm talking about FIFO, I know I'm working from the top down, because when we write in America, we start at the top and work our way down the sheet. So FIFO would be in a list. The first item we bought is at the top and the last item we bought is at the bottom. So whenever I'm trying to get cost of goods sold, I start at the top and I work my way down until I reach the number of units sold. The important thing is to know when to stop. That's also a good thing to keep in mind on Thursday nights. You have to know when to stop. But in any case, what we're going to do is start at the top, which is going to be 2 units at 70 for 140. And then we sold 4 units, so we need another 2 from the next group, which would be at $80. Notice I didn't use all 4 from the second group on January 12th, and I guess for note purposes, I should label these for you. I only used 2 from the January 12th group because I only needed 2 more to make the 4 that I sold. And we're getting cost of goods sold here. So that gives me 160 for a total of $300 for cost of goods sold under FIFO. LIFO we'll do in a minute. Let's get the ending inventory, under FIFO. So the way I approach all of these is I start by getting cost of goods sold. Even if the question asks for ending inventory, I get cost of goods sold first, because ending inventory is simply what remains. So if I know I used the entire top group and I used 2 out of that second group, ending inventory is going to be 2 from the second group at 80, so that's from January 12th, and then the 1 from the January 14th group at 100. So that's going to be 160 and 100 for a total of 260 for my ending inventory. The great thing about getting cost of goods sold and ending inventory using these methods is you can double check your work. If you add cost of goods sold to ending inventory, you should always arrive back at the cost of goods available for sale, because the whole point of these inventory methods is to simply break up that cost of goods available for sale into the amount that's been sold versus the amount that is left over. So when we're done, we add cost of goods sold and ending inventory together. We should always arrive back at the cost of goods available for sale. Students sometimes struggle with this, and I think it's because you're making it more complicated than you need to. You just need to remember that under FIFO, we start at the top because we're the first items at the top. We work our way down until we achieve the number of units sold, and ending inventory is simply the leftovers. With LIFO, which we'll do next, we're going to go and do the opposite. We're going to start at the bottom and work our way up. So let's do that, shall we? So with LIFO, remember, I had ending inventory of 3. That hasn't changed. So cost of goods sold would be 4 units. So for LIFO cost of goods sold, I'm going to start at the bottom with January 14th, and I'm going to have 1 at 100 for $100. Then I'm going to move up to January 12th. And I don't need all of those. I only need 3 more at 80 to make up the 4 that were sold. So that's another $240. So that means my LIFO cost of goods sold is going to come out to $340. With LIFO, remember, we're starting at the bottom to get cost of goods sold and working our way up. With FIFO, we start at the top and work our way down to get cost of goods sold. So how do I get ending inventory? It's simply what's left. Well, we used all of the bottom group. We've used 3 of that middle group. So we have from January 12th, 1 unit at 80 left for a total of 80. And then our beginning inventory, the entire 2 units are left at 70 for 140, giving me a total number of units of 3, which makes sense. That's what's left over. And then we have a total amount of 220. Double checking my work, 340 plus 220 equals 560, so all is well in the world. So hopefully that makes some sense. Again, with FIFO, we start at the top and work our way down to get cost of goods sold. With LIFO, we start at the bottom and work our way up. You just have to remember when to stop. We sold 4 units, so we have to stop once we get to those 4 units for cost of goods sold. Ending inventory will simply be whatever's left over. Average cost is very easy, but you have to understand it's not a simple average. Because if I buy a whole lot more of expensive items, my weighted average is going to be skewed towards those more expensive items. It's just like your grade in this class. We don't take a simple average of all your grades divided by the total. Instead, some of the grades, exams, and quizzes will count for more than other components of the course. So we have to create a weighted average. To do that, it's going to be quite easy for inventory. What you're going to do is step 1 is going to be to calculate average cost. And to do that, you're going to take your cost of goods available for sale divided by the total units. So for this case, it's 560 is the cost available to sell, and we have a total of 7 units. And that's going to give me my average cost per unit. So 560 divided by 7 is 80. So that will be our average cost per unit. Step 2 is going to be to calculate cost of goods sold, which is going to be the number of units sold times our average cost. So the number of units sold, remember we had ending inventory of 3, so the units sold is 4. So we're going to take 4 times our average cost of 80. That's going to give us 320. And then step 3 is going to be to calculate ending inventory, which is going to be the number of units left over times the average cost. The number of units left over would be 3 times the average cost of 80, which would give me 240. And then, lo and behold, 320 plus 240 is indeed 560. So that's our verification that we did it correctly. Again, with specific identification, we're going to tell you exactly which units are sold. So I'm not doing an example on that because you're literally just told which ones are sold. So if I told you that we sold 4 from January 12th, then cost of goods sold would be 4 at 80 or 320, and then the leftovers would be the beginning inventory in January 14th group. Basically, you just have to do whatever you're told for specific identification. It only makes sense to use specific identification when we have high value items that are low volume, like jewelry, houses, etc. Cars would be another example, because that's the only time it really makes sense to track each individual unit that you sell, which is what's required in order to do specific identification. The next several slides I'm going to skip over. It's the book's version of teaching you how to do each of these methods. I will just show you one thing before I skip through, and that's the way they show you how the different inventory methods work. They show you with a visual, like stacking boxes in a bin. So with FIFO, you could see our first items are at the bottom, then we add our purchases on top of it, and then we use the ones that were put into the bin first. The reason I don't like this method is it implies that FIFO is using the bottom. But whenever you're presented this stuff on an exam or a quiz, it's going to be in a list format, not a picture. So in the list format, the old stuff's always at the top because we write from the top and work our way down. So that's why I'm not a big fan of this approach. So that's why I'm going to skip over this. I leave it in the slides simply because it corresponds with the textbook, and some of you might connect with it and might like it better than my way. But I highly recommend you follow my way, because then I can just use the words and it tells me what to do. FIFO says start with the first. I know in a list the first is at the top. LIFO says start with the bottom, and I know in a list the bottom or the last one is at the bottom. So I fast forwarded, so you may want to pause the video and fast forward your slides if you're taking notes on them, or flip to the slides if you printed them. But we're going to pick up here where we talk about perpetual inventory and periodic inventory. When we're doing those examples that we did, we're practicing a periodic system, meaning we're calculating cost of goods sold once at the end of the period, which makes things a lot simpler. With FIFO, it really doesn't matter because cost of goods sold is going to be calculated the same way under a perpetual or periodic basis. But with LIFO, that last one in is always going to be changing because you're buying goods throughout the year and you're selling goods throughout the year. So it makes the calculation far more complicated. So on our exam or quiz questions, if you see using the perpetual or the periodic system rather as part of your LIFO and FIFO problems, all that means is that you're going to do the problems the way I taught you. We never go through LIFO and FIFO and average cost using a perpetual system. We do our journal entries under a perpetual system because that's what most companies use in reality. But for simplistic purposes, we calculate cost of goods sold once at the end of the period when we're doing our FIFO and LIFO or average cost calculations to keep things simple. GAAP allows companies to choose among the various inventory methods that we talked about. Average cost is also known as weighted average, but IFRS prohibits the use of LIFO. So what does that mean? Well, it means if you're comparing companies that are international versus domestic, it may make it a challenge to compare two companies if they use different inventory methods. That's why it's going to be important to review the notes to the financials to find out which method the company is using, because as we're about to see, each method that we used resulted in different answers for cost of goods sold and ending inventory. So this is a summary of the answers that we calculated together for Harley-Davidson under the various inventory methods. Sales are assumed to be $480 for these jackets. That doesn't change and isn't impacted by the inventory method that the company chooses. However, you could see cost of goods sold is. Under FIFO, cost of goods sold is the lowest. Under LIFO, it's the highest, and then average cost is going to be in the middle. And you'll find that average cost always ends up in the middle. That's why it's an average. FIFO and LIFO, which is the higher or lower, will depend on whether prices are rising or declining. We'll talk more about that in a bit. However, at this point, it's important to understand that because cost of goods sold is different under each method, our gross profit ends up being different, as does our income, our taxes, and our net income. Our ending inventory, the amounts left over on the balance sheet, are also different under each method. You could see that FIFO, in our example, makes this company look far better. It has a higher income at 75 and a larger amount of assets left on the balance sheet at 260. LIFO makes the company look far worse, only 45 in income and only 220 in assets remaining. Keep in mind, this is the exact same company. So using different inventory methods can give a much different picture of the company, which is why disclosing in the notes the method the company uses is so important. It's also why it's important for you to understand the different impacts that each method has. So when you're comparing companies in your future, you'll be able to understand that if a company uses FIFO and LIFO, it's not fair to do a side-by-side comparison of their net incomes, because the impact of the inventory method will result in different incomes being calculated. Average cost, of course, falls in the middle for both net income and the ending inventory on our balance sheet. So this slide basically tells you generally what happens, and it's called the normal financial statement effects, because this is what happens when you have costs going up, and this is what happens when you have costs going down. Now, I don't ever like to memorize a whole bunch of things like this. It doesn't make a whole lot of sense to me. So instead, I like to give myself a little example, because I'm going to freak out on an exam or quiz, and I'm going to make mistakes. So what I would do is this. In a period of rising prices, I do myself a little example. 1 unit at, say, $5, 1 unit at $6, 1 unit at $7. Declining prices would be 1 unit at $7, 1 unit at $6, and 1 unit at $5. I just chose these numbers. You could use any numbers you like. But you have to make sure prices are going up or down in your example. No matter what's happening to prices, FIFO cost of goods sold, if we were to sell 1 unit, would come from the top. LIFO cost of goods sold would come from the bottom. And as we already said, average cost of goods sold is somewhere in the middle. So by doing this little example, I can easily answer any question I might be asked. For instance, in a period of rising prices, which method gives me the highest cost of goods sold? Well, 7 is the highest under rising prices, and that corresponds with LIFO. If it were declining prices, 7 is still the highest number, but now the answer is FIFO. This little cheat only helps you to get cost of goods sold. So you also have to understand the relationship cost of goods sold has with other items. So cost of goods sold has an opposite relationship with gross profit, net income, taxes, and ending inventory. So what does that mean? Well, it means if I'm asking you which method gives me the highest gross profit, if I want gross profit high, it means I need cost of goods sold low. Then I can go and use this cheat chart. So in a period of rising prices, which method is going to give me the highest gross profit? The one that gives me the lowest cost of goods sold. The low is 5, so that corresponds with FIFO in a period of rising prices. If I wanted to know which method is going to give me low taxes, in order to have low taxes, I need the opposite for cost of goods sold, high cost of goods sold. So in a period of rising prices, which gives me the high cost of goods sold? The 7. So the answer would be LIFO. The answers obviously flip if we do declining prices. I don't memorize any of it. I just use this little chart to kind of help me through it. Why is cost of goods sold the opposite of all of these items? Well, cost of goods sold is an expense. So if expenses go up, I hope you remember, revenue minus expense equals net income. So as expenses go up, my net income, gross profit net income, would go down, as would my taxes, because taxes are a function of net income. Lower income, lower taxes. Ending inventory is the opposite of cost of goods sold, because if I sell the expensive stuff, what's left over? The cheap. And if I sell the cheap stuff, what's left over? The expensive. So that's why this little chart works, where everything on one side of the line has an opposite relationship to the other. So whenever you're asked a conceptual problem about periods of rising or declining prices and which method gives you the highest or lowest anything, use these little cheats to help you through, and you'll be able to come up to the right answer each and every time.